Before we begin, a quick reminder. All information in this video is for educational purposes only and is not financial advice. Now let's get into it. Last night at 2 a.m. Eastern Time, while the financial world slept, something happened in the silver market that was not supposed to happen. The price fell into a void. In a matter of minutes, it collapsed by almost $10, from 83 down to 73.72. There was no news. There was no apparent reason. This was not a market crash. This was as if someone had simply deleted the floor from underneath the market. When I opened the chart this morning, I didn't just see a price drop. I saw a crime scene. A long, brutal red candle painted during the most illiquid time of the day, during the so-called ghost week between Christmas and New Year. It didn't look like the result of thousands of traders acting. It looked like the work of a single gigantic panicked seller. You are on New Era Economics, and this is an emergency investigation. Subscribe to learn more. Our investigation is just getting started. Most media outlets today will call this a correction or retail panic selling. That is a lie. What we witnessed was not panic. It was an execution. In this video, we will conduct a full forensic post-mortem of this ghost crash. I will show you what really caused it, an event that professionals call a VaR Shock. I will expose the accomplice mechanism, known as a gamma flip, that turned the fall into an uncontrollable nosedive. We will find the mysterious savior who injected $34 billion into the system at 3 a.m. to prevent a full-blown collapse. And most importantly, I will prove to you why this event, this nightmarish crash, is actually the most bullish signal imaginable, a signal that the market has been cleansed of its last weak link, and that it is preparing for a massive slingshot effect. Get ready. The investigation begins now. The first question in any investigation is, who is the victim? Who was that single gigantic seller that crashed the market at 2 a.m.? My analysis of the data and the very nature of this collapse indicate that this was not a conscious seller. This was an automatic, merciless liquidation. The victim was an over-leveraged whale, a large fund that had made too big of a bet. And the reason for this liquidation is one of the most hidden and most dangerous mechanisms on Wall Street. It's called a VaR shock, or a value-at-risk shock. What is VaR? Imagine that every major hedge fund or bank uses a complex computer program that, like a nervous system, constantly measures the level of risk in their portfolio. This program calculates the value at risk, the maximum amount of money the fund could lose in a single day with a 99% probability. This is their pain threshold. The fund's management sets a limit on this metric, let's say no more than $100 million per day. As long as the market is calm, the fund can build up massive, highly leveraged positions, and its VaR will remain within the normal range. But VaR is not a static number. It is dynamic, and it explodes when volatility in the market increases, when prices start moving too fast and too unpredictably. Now let's reconstruct the events of last night. Our whale was likely holding a huge, long position in silver using maximum leverage. When the price closed at its highs on Friday, he felt like a winner. But during the ghost week, the market became thin. A few relatively small sell orders caused slightly more volatility than usual. And at that moment, the fund's nervous system experienced a shock. Its VaR model suddenly recalculated the risk and showed that the potential daily losses now exceeded the established limit. A red light flashed on the dashboard, and an automatic safety protocol was triggered. This protocol doesn't call a trader and ask for his opinion. Its job is to immediately reduce the risk to an acceptable level. And how do you quickly reduce risk on a massive leveraged position? There is only one way. Start selling it, immediately, at any price. This is the VaR shock. It's not a human making a decision. It is a robotic executioner built into the risk management system that begins to automatically liquidate the fund's assets. It doesn't care what the current price is. It doesn't care that there are no buyers in the market. Its only mission is to follow one command: reduce risk, now. This is why the fall was so brutal and so vertical. The robotic risk manager began dumping contracts for millions of ounces into the empty overnight market. It was selling into an air pocket, into a void. Every sale it made pushed the price lower, which increased volatility, which made the VaR model scream even louder, which forced the robot to sell even more. It was a perfect self-destruction loop. We were not witnessing a market panic. We were witnessing the system coldly executing one of its own who had gotten too greedy. The liquidation of the whale due to the VaR shock was the spark, but to ignite such a wildfire, gasoline was needed. And my investigation shows that the gasoline was poured on the flames by an unexpected accomplice, the very same option sellers, or market makers, we discussed last time. They became victims of a mechanism that professionals call a gamma flip. Let's return to our insurance company analogy. Before this crash, the banks, our insurers, were primarily selling call options, insurance against a price rise. To hedge their risk, they were buying futures. This is called being long gamma, or having positive gamma. In this state, they were essentially allies of the bulls. The higher the price went, the more they had to buy, pushing the price even higher. But the drop from 83 down to, say, $78, caused by the whale's liquidation, changed everything. At that level, the market crossed a critical point. A huge number of call options became worthless, while the demand for put options, insurance against a price fall, suddenly surged. The banks, to make a profit, began selling those puts. And at that moment, the gamma flip occurred. By selling insurance against a fall, the banks found themselves in a new mirror image reality. Now their risk was no longer in the price rising, but in it falling further. To hedge this new risk, their algorithms were forced to do the exact opposite of what they were doing before. They now had to sell silver futures. This state is called being short gamma, or having negative gamma, and it is one of the most dangerous situations in a market. In essence, the market makers went from being firefighters to being arsonists. Now imagine what happens. The whale's robotic executioner is selling to reduce risk. That selling pushes the price down. The price drop forces the bank's algorithms, which are now short gamma, to also sell in order to hedge their risk on the puts. Their selling pushes the price even lower. This, in turn, forces the whale's robot to sell even more. This is that very robotic doom loop we talked about. Two different automated protocols, one trying to save a fund from bankruptcy, the other trying to save a bank from option losses, enter into a deadly resonance. They start selling to each other, amplifying the fall and sucking all liquidity out of the market. This was no longer trading. This was a battle between two Skynets, two robotic systems gone haywire, with everyone else caught in the crossfire. This is why the fall was so fast and so deep. The VaR Shock was the first blow. But the gamma flip was the accomplice that kept striking, turning a controlled liquidation into an uncontrollable nosedive. The system began to eat itself. And at that moment, it was on the brink of a full systemic collapse. So, two robotic systems entered a death spiral, sucking all liquidity from the market. This was the moment of maximum danger. When there are no buyers and no sellers in a market, it ceases to exist. This is called a clearinghouse collapse, the nightmare of every regulator. It would have meant that the CME Group, the central hub of the entire Western financial system, could have defaulted. And it is here that a new character enters our investigation. At 3:15 a.m., at the height of this chaos, a mysterious savior stepped onto the stage. How did I discover this? I began to analyze not just the silver market, but the circulatory system of all finance, the repo market. This is an obscure but critically important market where banks lend money to each other overnight against treasury collateral. It is in essence the plumbing of the entire financial system. And the data from this plumbing from last night showed a shocking anomaly. At precisely 3:15 a.m., the Federal Reserve conducted an emergency repo operation, injecting $34 billion of extra liquidity into the system. Officially, this was a planned technical operation, but the timing and the size tell a different story. Let me put this in the context of our investigation. At the very moment the financial system began to choke due to the collapse in the silver market, an invisible hand suddenly turned on a respirator. Those $34 billion were likely funneled to the very same large banks that were trapped in the gamma flip and on the verge of default. It gave them the necessary liquidity to stop the cascade of automated selling. In essence, this was a secret, undeclared bailout. They didn't save the silver market. They saved themselves from the consequences of its collapse. It was this emergency injection that put a floor under the falling market at the $73 level. The price stopped falling not because natural buyers appeared there. It stopped falling because the central bank placed an invisible safety net of newly created money underneath it. This leads us to two crucial conclusions. First, it proves just how serious the situation was. Central banks do not intervene in the market at 3 a.m. for minor issues. They did it because they saw the risk of a systemic contagion that could have spread from the silver market to all other markets. And second, it raises the main question, why did they need to do it? Who exactly were they saving with such desperate speed? The answer is obvious. They were saving the very same too-big-to-fail commercial banks that are the architects of this entire paper system. This was not a rescue of the free market. This was a rescue of the cartel. But this rescue had unintended consequences. The 3 a.m. rescue operation prevented a full collapse of the paper market. It put a floor under the price at $73. But in my investigation, I discovered that while all attention was focused on this drama on the COMEX, on the other side of the planet, the reality was completely different. While paper silver in New York was falling into an abyss, the The physical market in Shanghai didn't even flinch. When trading in the West closed on Friday, the price on the Shanghai Gold Exchange, where they trade real bullion, remained at a level equivalent to approximately $89 per ounce. Let me repeat that so the scale of it sinks in. At the very moment that paper promises in the West were worth $73, the real metal in the East was worth $89. The gap, or spread, between paper and reality reached a historic $14 an ounce. That's almost 20%. This is that very reality split we've been talking about. It is no longer a theory. It is a fact that you can see on the charts. The arbitrage that should have instantly closed this gap is completely broken. This proves that there is no longer a connection between the two markets. They are living in different universes, and the evidence confirming this continues to pile up. Right before the ghost crash, I noticed another anomaly in the COMEX reports. 600,000 ounces were withdrawn from the Loomis vault in a single day. This was no ordinary transaction. This was strong hands, perhaps that same industrial giant or sovereign wealth fund, deciding not to take any chances and demanding delivery of the real metal while it was still possible. They could feel the system cracking at the seams. They understand what is now becoming obvious to everyone. The price on the COMEX screen is a fiction. It is the price in a paper casino in the West that is on the verge of bankruptcy and is only being saved by emergency liquidity injections. The real price today is being discovered where the real metal and the real demand reside. And that place is Shanghai. What happened last night was not just a crash. It was a moment of truth, the moment when the Western paper market was forced to admit its powerlessness and call for an emergency rescue, while the Eastern physical market continued to trade calmly 20% higher. The mask has been ripped off. We are seeing two different worlds, and they will never be the same again. So what conclusion does this investigation lead us to? Last night, we didn't just witness a price drop. We witnessed an event that I call the Great Cleanse. The financial media today will feed you one story. Retail investors panicked and started selling. This is a convenient lie. As our analysis has shown, the only seller was a single, force-liquidated institution. The data from ETFs and dealer reports, on the contrary, show that retail investors were aggressively buying this dip. So what really happened? The system cleansed itself of the last major, leveraged speculator. The last weak link has been removed from the market. Now, only the strong hands remain in the long positions: industry, long-term investors, and those who understand the fundamental picture. The market has become healthier, it has become stronger, and this brings us to the forecast for the future. In trading, there is a pattern known as the slingshot effect. Imagine pulling back the elastic band of a slingshot. The further and harder you pull it back, the price drop, the more force and speed the stone, the price, will have when you let it go. Last night's liquidation was exactly that, the pulling back of the elastic band. It has created an incredible amount of coiled energy in the market, and now that the selling pressure is gone, that band is ready to fire. I expect that when institutional investors return from their holidays after January 2nd, this is the picture they will see. A market cleansed of speculative leverage, a confirmed physical deficit, a historic gap with prices in the East, and a floor put in by the central bank itself at $73. This is the strongest buy signal one could possibly imagine. The ghost crash was not the end of the rally, it was its reset. It was the necessary shakeout before the next most powerful leg up. Don't let the media narrative fool you. Look at the data, and the data says the slingshot is loaded and ready to fire. You are on New Era Economics. Subscribe. We will be tracking these events in real time. Thank you for watching, and I'll see you in the next video.